It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and I'll tell you what, I've been getting a lot of feedback from folks, and it's been great, actually, and it's been a lot of fun having folks share with me, and you can, like I said, contact me. The best place is contact me at yourpersonalbank.com. If you have a question or something you want me to cover on air, I'd be happy to do so. Mostly I'm getting responses, hey, this is great, I've been listening to you. It's kind of funny, I've been listening to you for several months. The more I listen to what you're sharing, the more interesting, the more it makes sense. That's one of the things I get all the time. Just more and more it makes sense, and more where I probably should really look into this. And again, the reasons for looking into this concept, the personal bank concept, are many and varied, actually. There's quite a few reasons. And again, just as a quick refresher, what is your personal bank? Again, it's very simple. We're setting up a high cash value policy designed to grow cash. This is not a policy that most people typically look at or are familiar with. We have companies that have been paying 6% dividends the last 25 years in a row, have never missed dividends since before the Civil War. That's one of the comments I get a lot all the time is, wow, I had no idea there were companies out there that had been doing this. I said, yes. In fact, many of them name companies. When I share the names, people immediately recognize, oh, yeah, I had no idea. So these are A-plus rated companies, strong dividend payers. That's their purpose. That's their goal. That's what they do. That's what they hang their hat on. And then the second piece of it is, of course, we set up a bank line of credit. So we're taking the insurance banking concept. Some people are starting to get a little bit more, been introduced to the idea, which I think is great. But we're taking it to another level. And we're literally, by adding on the bank line of credit, what we're doing is we're creating a positive arbitrage situation on the dollars you spend. In other words, as I say this all the time, if you put your money in this, the dividends, like I said, have been paying 6% plus last 25 years plus. If you leave it there, it's going to grow, right? If you access it and you take the funds from the bank line of credit, not from the policy, you don't take a withdrawal or policy loan, you take it from the bank line of credit. And the lines today are charging somewhere between 3 and 3.95%, depending on the size of the account and type. So if you're earning 6, you're getting crediting 6, and you're getting charged 3 to, let's say 3 to 4, what's your money still doing? Well, it's still growing. Everybody understands that question when I answer. They get that answer right when I ask it. So in other words, you can pick up a 2 or 3% interest, dividends, whatever, on your money that you spend. Now, why is that such a big deal? Well, there's a little concept out there called compound interest. And compound interest is, it's been called many things, but some people call it the eighth wonder of the world. Compound interest over time can dramatically change a person's financial situation. Particularly the more time you have, the younger the person is, the more compound interest can impact that person's finances. I just read an article. It did my heart good. It was a great article. It was this younger lady, and she shared this story that her parents, her dad actually shared with her. And by the way, this is so awesome because, I'm in the financial world. I've been in the financial world over 22 years. I share financial concepts, financial literacy things all the time. And many of them I had to learn myself. I was not taught much of this stuff growing up. But the number one influence, we all know this, on kids are their parents. And one of the things that a parent or grandparent can do, and I hope some of you listening, get this in your heart, put this in your heart and make this a purpose or goal. This year, 2020, has certainly been crazy. And there's been a lot of financial stuff involved and many other things involved. But understanding finances and having a good, solid financial backing and understanding is something that, I would love to see parents and grandparents take more charge of. Okay, it's kind of been almost a lost art in our society. It's kind of funny. Money is one of those things that people don't talk. Money and politics and religion seem to be kind of some of those taboo subjects. The reality is they shouldn't be, particularly in a family. And many of you I know, Money Radio here, are parents and grandparents. And so I hope And because you have a focus on money, and many of you have been very successful in your investing career and lifetime and such, and we've all made mistakes. I mean, no one, you even read Warren Buffett's book. I mean, Warren Buffett is probably a person who's probably made more good decisions about money than most anybody. But he admits himself he's made mistakes along the way. We all do. But the reality is, most of the folks listening to this show right now have made a lot of good financial decisions, and their financial situation has been rewarded as a result. Others I know that are listening because they want to gain that knowledge and understanding, and that's awesome. When you focus on something, that's when you tend to get better at it, right? So my point is, I hope many of you parents and grandparents take this on as a challenge or a goal, whatever, and teach some money concepts. And I did an interview not too long ago, and I thought it was really interesting. The interviewer asked me, one of the questions he asked me, and I was surprised, I wasn't expecting it. But one of the questions, he says, if you were dealing with a young person, what would be the number one piece of advice you'd give them from a financial standpoint? And I thought that was a phenomenal question. I had to think about it for a sec, but I did not think about it very long, because really the first thing that came to mind, I think, again, is the most powerful, is compound interest. The power of compound interest and what it can really do. And as we all know, compound interest is 1 to 2, 2 to 4, 4 to 8, 8 to 16, and so on, right? And this article I read in fact, this morning, it just kind of did my heart good. The story was that this young lady, she was college age, and she was excited because she went out and bought her first purse. It was a Coach purse, she mentioned. And this was some years ago. But she said she didn't remember what she paid for it, but it was a couple $100 she remembered at the time. And she came home with her. She was all proud of this new purse. And her dad said to her, and I thought this was so powerful, and she pointed out, very impactful in her life. But her dad said to her, she mentioned how much she paid for it. She found it on sale, whatever. So she was excited. And her dad stated, well, I hope you enjoy that $1,500 purse. She goes, no, Dad, I paid $200 for that purse. And he said, no, I hope you enjoy that $1,500 purse. And they argued back and forth for a bit. And then till her dad explained that if you'd taken the $200 instead and invested it, and again, I'm preaching to the choir here, but if you had invested it in your lifetime, that $200 could have easily turned into $1,500 through compound interest, even if you put it in something safe and guaranteed with consistency. That's not even taking on risk, right? Well, as she pointed out, that lesson she's carried for her life since. And the thing is, I share with people, is it's not that you can't go buy a purse or you can't go buy something that, we all have needs. We need to eat, food, clothing, housing, stuff like that. Those are, obviously are needs, but there's want. We have things we want too. And I'm not saying you can't go out and buy something that you want, like a purse or a coffee or a car or whatever that may be. But it is important to understand the true cost of that item when you purchase it. In other words, when you trade the dollars for that item, you can't just look at the cost of the item. You have to look at what could those dollars have done for me, even if I just invested them, let's say, in just something conservative and with consistency and guarantees. Because with risk, we risk up or down, we don't know. But with some consistency, we can put a number on that. Like I said, with the 6% dividends, that we can show what that would be. Now, what I love about the Your Personal Bank concept is it actually allows somebody to take advantage of that compound interest, yet still purchase those items that we want and need, and still benefit on some of that compound interest. I'm going to explain further what I mean by that and how it can be a game changer in your financial future in the next segment, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. Today we're talking about, compound interest and the power of that. And again, most people understand compound interest is powerful. What I find when I work with people, and I'm talking about even sophisticated investors, I find very few truly understand the true power of compound interest. And in the last segment, I even shared the story of the gal that younger person who she purchased a purse for about $200, and she was proud of herself. It was like her first major purchase as a college student. And her dad said to her, "Well, I hope you enjoy that $1,500 purse." And she didn't understand what he meant at first until they discussed it. That of course the $200 could have turned into $1,500 conservatively if she had just invested in something consistent and steady in her lifetime. Now, that is absolutely powerful and true. And I'll share one more other thought and story I share with folks all the time. And again, I'm kind of sharing some of this stuff because my hope is that some of you folks listening, parents and grandparents, take it upon as a goal, a challenge for your family, you and your family, to share some of the wisdom that you've learned in your financial lifetime, and share this with your family, so that because let's face it, you probably know, maybe more than most, that if the power of compound interest, go back and look what it could have done for you. The younger folks don't necessarily understand that. Financial literacy is not taught very commonly. And of course, it's, the most powerful sources are from the family. So the thing is, I share this all the time. I've heard this so often where people say, well, you can't teach millennials anything. I disagree. I've actually had tremendous success and enjoyed working with a number of my clients who happen to be millennials. I've got clients across the board, of course, age-wise, but I've got a pretty good segment of millennial-age clients, and I love working with them because, one, they're intelligent, they're very nice folks to work with, many of them are open and coachable and want to learn. And most of the time, frankly, when I'm meeting with a new millennial client, it's coming from their parents who is already a client. So typically when I meet with them, it's because, mom or dad or grandparents said, you should meet with this guy. And so now before COVID, we'd meet in person often. They would want to meet at a coffee shop. It's kind of a cliche, but it's pretty accurate. And again, most of the time I was referred to them. So it's funny how often I'll let, they'll offer to buy the coffees, and I'll let them. And it's kind of funny. So as we're discussing compound interest and the personal bank concept and how you can grow your money consistently over time, then I'll share them with this idea of compound interest, just like this dad did with the daughter with the purse. And it's kind of funny where I'll look at them and based on their age, where their money could I use 5 or 6% because we have companies paying dividends of 6%, right? Have last 25 years plus. Never missed dividends since before the Civil War. When I show them what a 5 or 6% compounding can do over a number of decades, when they realize that things can increase 10 and 20-fold in their lifetime, literally, and this is tax-free too, by the way, so we don't have that aspect. They'll look at the 2 cups of coffee they just purchased, and I don't know, they're around $5 a piece roughly, right? So it's about $10 or so they spent on coffee, give or take. And they will literally look at the coffees. They'll look at me, and I won't quote the exact words often, but it's, oh my gosh, I just spent $100, or I just spent $200. And I look at it and I said, bingo, you got it. You understand what I mean by the putting money away and then letting it grow and compounding. And then the only bad thing about that story is then when we meet again, they usually make me buy. So, but at least it's a business deduction. So, the point is, putting money away for the future and compounding over time can dramatically change your financial future. And obviously, this is one of the biggest lessons that any younger person, particularly, and frankly, anyone even in their 40s or 50s can still take advantage of, because folks we're living a long time. So these concepts of compound interest, even though somebody's in their 40s or 50s or more even, they can still take advantage of those things. Also, your personal bank does a couple of other things. We can structure what's called family legacy. So what if you're in a situation where you're beyond the 40s, 50s age, maybe you're in the 60s and 70s, okay, or so. Well, and even 80s. I've got a number of clients that set up personal banks because they want to set them up as a family legacy. In other words, they can start that compounding and that tax-free and pass on to the next generation tax-free and get the positive arbitrage and everything. and then pass that on when they're gone to the next generation, all on a tax-free basis. I mean, the bottom line is there's probably no financial tool, more efficient in passing assets from one generation to the next than life insurance, particularly from a tax standpoint. And when you look at the taxes that, particularly with IRA, 401k qualified accounts, I mean, many folks refer to those as what's called tax hostile accounts, particularly when you're looking at passing on to the next generation. And some of the recent tax laws that have taken away stretch IRAs now and things like that, they're very tax hostile, particularly when you're talking about going into the next generation. We have solutions for that, okay? And so you can pass on a significant amount of assets on a tax-free basis to the next generation. But more importantly in that is you can actually have use and control of those assets now while you're living. See, one of the questions I've shared with folks so many times over the years is, particularly when I'm dealing with grandparents, let's say, just as kind of a rule of thumb, folks who are retired, and I'll ask them about and looking at their financial situation and whatnot. And typically one of the questions I'll ask is, have you given some thought about charitable giving? And the answer in most cases is a positive one. Most cases they've thought of it. And then I'll say, well, and they might share with me some of the things they've looked into. But I'll say, well, correct me if I'm wrong, but pretty much every solution you've looked at pretty much entails you giving up control of the dollars during your lifetime to be able to then pass it on a tax-favored or tax-free basis. And I'm like, yes, exactly. And I said, again, correct me if I'm wrong, but your concern is if you don't have if you give up control of some of those dollars, you might not have enough. Because what if you have a major health situation or long-term care or whatever that comes up and you've got to cover that and now you don't have the money to do it? Am I right? And invariably, that's absolutely the situation. Very common that I run into. So then my question to the folks is really simple. If I could show you how to set up a plan that gave you control of the use of the dollars, tax-free, while you're living, and then pass it on tax-free to the next generation, would that interest you? The answer invariably, almost always, is absolutely. I mean, I'm all ears. And so that's, again, where your personal bank solution can be a real key. We can grow monies consistently with guarantees. We can go into index options, which I'll talk about in the next segment. We can have guarantees on it. We can have tax-free, tax benefit. I mean, during your lifetime, you have control. And by the way, like I spoke in the last Tuesday show, there are living benefits built into all of these plans where you have access to dollars, significant amount of dollars for critical, chronic, long-term care expenses. Okay, so you got that covered too now, all right, or a long ways to covering that. So we're addressing a lot of those issues over and above just what the return on the money is. The returns are fine. They're solid. They're consistent. They're steady, or we can do the index, which I'll get into. But there's more to it than just that. And so, in fact, that's one of the common critiques that I hear about from other advisors. They'll say, well, if you invest your money over here, you could potentially get a better, higher return. That may or may not be true. Obviously, that depends on what the markets do and what that investment does, right? Having downside guarantees, protections is powerful. Also, what's the tax consequences? We got to look at that. But there's more to your money than just what it actually returns. What about unexpected expenses? Medical, long-term care, whatever. Is that covered? What if somebody passes away prematurely? Is there a income replacement plan in place to replace Social Security income or pension income, for example? We're going to talk about that more, and I'm going to talk more about the index options in the next segment that can get you more return with the safety and guarantees. So don't miss this. Stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right. Well, we've been talking about a lot of different situations where your personal bank can be a really good fit. The last segment, I was talking about what we call family legacies. In other words, how do you maximize efficiency in passing monies on to the next generation on a tax-favored or tax-free basis? How do you have control access to monies now, and still be able to do charitable type of work? those kinds of things. Can you qualify, health-wise, age-wise? We've discussed that. We can, insure somebody else. There's a lot of different solutions and things that can be accomplished. We were talking about compound interest at the first segment, where for a younger person in particular, and when I say younger person, I'm talking about somebody that is even in their 50s, even early 60s, can benefit from compounding and compound interest. Of course, if somebody maybe is in their 70s or 80s, okay, maybe the compound interest benefits obviously are not as strong, but by setting up a family legacy, something that passes on to the next generation, that person, that parent or grandparent, can then ensure the compounding is going to be of benefit to the family and the next generations. So just because somebody's in their 70s or 80s doesn't mean compound interest isn't important to them, okay? And the personal bank can, of course, accomplish those kinds of things. And like in my first point I was making about compound interest is, and I forgot to mention, is the problem a lot of younger folks have is they understand if they put money away and invest down the road, they're going to have a whole lot more, but they have things they want and need now. Well, your personal bank can actually address some of both. And why that's the case is, again, by setting up the high cash value policy. We got dividend payer companies, 6% plus, the last 25 years plus. Never missed a dividend since before the Civil War. So these are long-term, strong dividend payers. And then you access the funds from the bank line of credit in the threes. You're still picking up 2 or 3% positive arbitrage. You're keeping the difference, right? So if that younger person is putting some money away and then needs those funds for things that they need or want, they can purchase those items and still pick up 2 or 3% positive arbitrage on dollars they've spent. I mean, folks, think about this. Think about in your lifetime. How many dollars have you spent in your lifetime? I mean, most people don't even really think about that. But let's just use a quick example. Let's say you spent $50,000 a year on just, food, housing, clothing, stuff. Many of us spend much more than that. But let's just say it was only $50,000 a year. In your adult lifetime. In 50 years, that's that's a lot of money, right? So you see, 50. I mean, you can see where I'm saying is, we're talking about folks spending like $1 million in their lifetime or more often, and just expenses, stuff that they want and need, right? What if you could pick up a couple 3% positive arbitrage on all those dollars? And what if, you're halfway through, you missed some years? Okay, fine. What if you could pick it up for the rest of the way? What if you could teach that to the next generation and allow them to pick it up for their most, if not all of their adult lifetime? If you picked up an extra 2 or 3% compound on $1 million in your lifetime, do you realize how much more money that would be? Oh, by the way, that's extra over and above. That's gravy on top. That's not just what you make. Because, of course, if you choose the fixed option, like I said, they've been paying 6% past 25 years plus. I'll show you the charts. If you take the index option, the returns have been 8.5%, tax-free, with guarantees, downside protection. That leads me to the indexing. So last week, I was speaking to a new client, and we had just set up a personal bank for him. He was actually he newly retired. Very intelligent guy. He was a higher up executive with one of the major companies. I won't say which one here in town. And he'd just gotten through the March COVID crash. He had lost nearly half of the values, over a third of his portfolio. Fortunately, so we were talking through those time frames. He was really concerned about what was going on, of course. Fortunately for him and many people, the recovery in the markets happened quite quickly. I think much more quickly than most people expected. And so it was almost, he called me back. And I said, "You've kind of been given a second chance." He goes, "Yeah, exactly. It's like a reprieve." He goes, "I'm ready to pull some funds out because I don't want to deal with that again," because he was retiring. And so we put it in the personal bank, and he's getting a little over 6% and all that. Tax-free, all that good stuff. He's happy. He was talking to another advisor about something and who has some understanding of the personal bank concept. And the question was asked, well, why didn't you choose an index option? So he asked me, he goes, why did we go with the fixed option versus the index? Now, understand the fixed option. I told you 6% dividends plus last 25 years plus, never missed a dividend since before the Civil War. So long-term consistent dividend payer versus the index option, which has a 1% floor and a 14% cap based on the S&P 500. So whatever the S&P does, that's what you get between 1 and 14 each year. If it goes down, it makes less than 1 or goes down, you still get 1. So your downside's protected. If it goes up 15, you get 14, okay? So it's really quite simple. The average on that particular index over the last 25 years has been 8.52%. 8.5% tax-free with downside guarantees means each year you lock in, you never go backwards. That's pretty strong. By the way, if you understand that last piece I just said, you understand the power of index options. Here's the thing. Each year when you get credited a gain, and then if the market goes down after that gain, it doesn't matter. Each year's gains are locked in. So it's like a stair step or a ratchet, a stair step approach to investing. I've heard those terms. I've used it myself. In other words, each year that your account goes up, you get that credit, and it goes up. If the next year it goes down, it doesn't matter. Your account does not go down from that point. So each year you have at the same or more money every single year. That is strong. So you have the double-digit potential on good market years, and you don't lose on bad years. In fact, you get 1%. Okay, so that's powerful. So it's a strong tool. And by the way, we can use this with the banking concept, the personal bank concept. We can access the funds through the bank line of credit in the threes, like I mentioned. 3.95 is the high end. So if let's say you got a 7% return that year, and then you access those funds from the bank line, you're getting credited 7, you got charged 4, let's say, rounded off. What's your money still doing? You still picked up 4% positive arbitrage. If you made 10% and you got charged 4, you're making 6% that year on money you spent. You can actually spend money and make a strong amount, okay? So he says, why didn't we choose the index option? I said, well, I was listening. If you remember from our various discussions, you mentioned the desire to have this money be safe and consistent. You were really concerned about the markets and what was happening, and you wanted to diversify some of your monies into this bucket that had some consistency and steady, like modern portfolio theory teaches. The 60-40 stock bond split that's used as a rule of thumb. This is part of your 40% bucket, the steady, consistent, the steady eddy. He goes, yeah, you're right. That makes a lot of sense. I said, the bottom line was I was listening to what you said. And if you remember, we talked about both options. We did talk about the index option, but you were you wanted to lean towards the steady eddy fixed index option. He goes, you're right. Or steady eddy option. He goes, you're right. Because in his situation, that was important to him right now. Now, he's looking at reallocating some more dollars and setting up a second personal bank policy. I said, that one, we may consider the index option because it has the higher upside potential of gains, right? He goes, yeah, that would make a lot of sense. So we have a bucket here that has the steady, consistent, tax-free, 6% last 25 years plus. We can also add another bucket, a second personal bank, that can have the upside potential of 14% per year, but won't lose on bad years. And you can still access through the bank line and get positive arbitrage and keep all the tax benefits. He goes, we can do both? I said, exactly. Stay tuned in the next segment. We'll talk about some more about how these combinations can make sense for an awful lot of people.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third, and we've been talking about a lot of different solutions today. We've been talking about the power of compound interest and using your personal bank, how you can enhance that, particularly for somebody that's maybe a little bit younger side. And when I say younger, I'm talking about somebody in their 50s, early 60s and younger, okay? Also, for those that are older than that, 60s, 70s, 80s even, you can set up what we call a family legacy, where somebody else, one of the family members may be the insured, you're the owner, but you're passing on the compounding and the tax-free and all that stuff to the next generation. In other words, you can pass on more dollars tax-free to the next generation than just about any other tool out there, okay? Then we were also discussing various things as far as the living benefits and things like that. These are things that are important if you end up with a critical, chronic, terminal illness. The death benefit associated with these policies, of course, allows you to offset loss of income, particularly if we're talking about a couple, his and hers, where they're both receiving some Social Security benefits or pension or those types of incomes. Somebody passes prematurely, one of the survivor, because you got a his and hers, there's the reciprocal, the survivor gets a nice chunk of money to offset that loss of income, okay? And then don't forget the positive arbitrage aspect. This is where we take this whole insurance banking concept to another level, okay? Creating that positive arbitrage so that you literally can access funds from your accounts. You don't access it directly. You actually let the money grow in the policy, either at the 6%, consistent, steady Eddie that's been paying the last 25 years plus, or the index option based on the S&P 500 with a 1% floor and a 14% cap currently. The average, historical average, last 25 years, 8.52. Okay, I show you the chart, show you the information. And you can access those funds, though, through the bank line of credit in the 3s, 3 to 395, depending on the situation and what we're dealing with, the amount of funds. And so if you're earning 6 and you're getting charged 3, what's your money doing? If you're in the index option and you're earning 8 or 9 or 10 or whatever it is, and you get charged 3, what's your money doing? It's still growing. And see, that is the game changer. The game changer is the compound interest. I'm sorry, compound interest is game changing. Don't get me wrong. The positive arbitrage. Because what the positive arbitrage, in other words, what is positive arbitrage? It's very simply the difference you get to keep for what you're earning versus what you're getting charged when you access the funds. And as long as there's a positive difference, in other words, you're earning more than you're getting charged, and I've shared this already many times, the fixed steady Eddie is getting credited 6 dividends, you're getting charged 3 to 395. So you have a 2 to 3% positive arbitrage. The index options are averaging 8.5 the last 25 years. And again, even if you're at the high end at the 395 and you're making 8.5, the positive arbitrage is the difference. It's about 4.5% positive arbitrage. Okay? So my point is simple. If you're making the difference, if you're keeping the difference, okay, and you do that over time, now compound interest comes into play, what ends up happening is you have more money to spend using this tool than you don't not using it. Okay? Your money's growing. You're getting nice. I mean, I don't know. I think most people today, if you looked at it, said, hey, my portfolio the last 25 years averaged an 8.52% return tax-free or after tax. I think most people would be satisfied with that. Also, if you had a situation where you understood that if the markets or whatever, your portfolio markets went down in the future, you would not participate in that. In other words, it's a stair-step approach to investing. Each year you get a gain and it locks in. You don't lose that gain. So if the following year is a bad one, doesn't matter. You got the previous year's gains. You see what I'm saying? So it's each year, it's like a stair-step. The amount of money you have is more than the previous year. So if you got an 8.5% return after tax or tax-free over the last 25 years, and you had a stair-step, you knew that it was never going to go backwards on you. And then you also knew you could access the funds at a lower rate than what it's been earning. So if it's been earning 8.5 and that continues and you're accessing it, let's say at 4 to be conservative, you're picking up a 4.5% positive arbitrage. In other words, you're making 4.5% on money you spent. Folks, do you realize how much more money you're going to have? And if you spent $50,000 a year on just expenses, we're talking about food, clothing, housing, stuff like that, that adds up. That adds up to a lot of money over time. And especially as you go forward in your retirement and you're more and more expenses, and yet you're still picking up positive arbitrage on those dollars, you end up with a lot more money in your pocket. Your money lasts longer. It keeps going, keeps growing, even after you spend it. I have an example of a client I was working with recently who she used this tool basically to pay off her house in retirement because she started having so much more money. She'd been using this for quite some time, this tool, and she started having so much more money in there, more and more money each year, she was able to pay off her house. And the money she used to pay off her house, we're talking about $100,000, she's still earning a couple percent interest on that, positive arbitrage each year going forward. So even though she took dollars to pay off her house, eliminate that debt, which made sense for her, in retirement, she's still earning some interest on those dollars. See the difference? See, typically most people, if they're going to pay off a house or whatever, or any item for that matter, once they pay that off, those dollars, you paid those dollars off, those dollars never work for you again in the future, do they? You gave up control of those dollars. You traded those dollars for that item, in her case, a house. Do you want to still earn interest on money you spend? Why give up control of those dollars? Folks, the lending industry is doing just fine. I don't think you need to keep subsidizing them and give them more money, do you? Don't feel sorry for them. They're doing just fine. They're making plenty of interest on us. Why not capture some of that or keep some of that and make it for yourself? You see, that's what the personal bank concept is really about. That is the game changer. So should you look into this? Well, if you want to generate compound interest on your money long term, absolutely. If you want to pass on that compound interest and tax-free to the next generation, you should look into this. You know, if you're concerned about medical expenses, long-term care expenses, and all that, and you want to have a way to cover those, well, you should look into this. You know, if you've got income and you want to protect against loss of that income, particularly things like Social Security and pensions for one or the other party of a couple, you should look into this. And if you want to have more upside potential without the downside risk, you like the stair-step approach to investing, well, you should look into this. And then lastly, and maybe the most important, if you want to earn interest on money you spend, and folks, we all spend money on things that we want and need. If you want to earn interest on those dollars and pick up 2 or 3% interest on those dollars you spend or more, well, you should look into this. How do you do that? Contact me at yourpersonalbank.com. We'll be happy to talk to you about it, look at your situation, and share how this can change your financial future.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.